Imagine an army of Wall Street professionals, Ivy League degrees, supercomputers, teams of analysts, and access to information you'll never see. Now imagine a fund that does almost nothing. It just buys 500 big American companies and sits there. Here's the shocking part. In 2025, 79% of those highly paid professionals failed to beat that boring do-nothing fund. Not a few of them. Nearly 4 out of 5. This isn't a bad year. It's one of the most consistent findings in all of finance, and it means you, with no special skills, can quietly outperform most of Wall Street with one simple investment. Today, we explain the index fund, what it is, why the pros lose to it, and why it may be the most powerful tool the average person has. Let's get into it. I'm Don Blake, and this is USAFinance, where we hand you everything you need to get, keep, and grow your money with nothing but sourced facts in plain English. This is education, not advice. I'm not telling you to buy anything or promising any return. Investing always carries risk. You can lose money, markets fall, and past performance never guarantees the future. What I can do is show you what decades of data actually say. And what it says is remarkable. The simplest possible strategy beats the expensive, complicated ones for most people, most of the time. Understanding why is genuinely empowering. Every number today comes from S&P, Dow Jones Indices, the SEC, and FINRA. If this changes how you see investing, subscribe. Let's begin. Let's start with the S&P 500 because the whole story hangs on it. The S&P 500 is simply a list, the 500 largest publicly traded companies in the United States. It's the household names and the giants behind them. The tech companies, the banks, the car makers, the brands in your kitchen. Together, these 500 companies make up the majority of the entire U.S. stock market's value. So when people ask, how did the market do today? They're usually looking at the S&P 500, the single best snapshot of American business as a whole. The country's biggest companies bundled into one number. It is not a company you can buy, it's an index, a measuring stick, which raises the obvious question, how do you actually own it? That's where the index fund comes in, and it's a genuinely beautiful idea in its simplicity. An index fund is an investment that automatically buys every company in an index in the right proportions. An S&P 500 index fund holds a slice of all 500 of those companies. So when you put in $100, you instantly own a tiny piece of the entire American economy. There's no genius manager picking winners, no trying to guess the next hot stock. The fund just mirrors the index mechanically. Because it does so little, it costs almost nothing to run, often just a few dollars a year per 10,000 invested. Buy the whole haystack, the saying goes, instead of searching for the needle. And the data says the haystack usually wins. Now the number that should reshape how you think about investing. It comes from something called the SPIVA scorecard, published by S&P Dow Jones Indices, which tracks professional fund managers against the index year after year. In 2025, 79% of actively managed large company U.S. funds underperformed the S&P 500. Nearly 4 out of 5 professionals, people paid handsomely to beat the market, lost to a fund that simply owns the market. Let that sink in. These aren't amateurs. They're full-time experts with every advantage money can buy. And most of them still couldn't outrun a strategy that requires no skill at all. And here's the twist that makes it even more powerful. It gets worse the longer you look. 1 year could be luck, so the researchers looked at the long game. And for the pros, the long game is brutal. Over a 10-year period, fewer than 1 in 6 active managers managed to beat the S&P 500. Stretch it to 20 years, and roughly 92% of funds underperformed their benchmark. And over a recent 15-year window, not a single category, 0 out of 22, had even a majority of managers beating the index. So this isn't a fluke or one strange year. The longer the race, the more the professionals fall behind. Time, which is supposed to reward skill, instead exposes how little edge most of them have, which forces the real question, why? Why do the experts lose so consistently? There are 3 big reasons. Reason number 1, and the biggest, fees. This is the quiet weight that drags active managers down. An actively managed fund employs analysts, traders, and managers, and it charges you for all of it, often somewhere around 0.5% to 1% of your money every year, sometimes more. An S&P 500 index fund doing almost nothing might charge as little as 0.03%. That gap sounds tiny. It is not. Every single year, the active fund has to overcome its own fee just to match the index before it's added $1 of value for you. The manager isn't just trying to beat the market. He's trying to beat the market by enough to cover his own paycheck. That's a steep permanent handicap. Let's make that handicap concrete because it's the heart of the whole thing. Say an active fund charges 0.8% more than an index fund. That means the manager must beat the index by 0.8% every single year just to tie, just to break even with the boring boring option. Do that consistently for decades, almost no one can. And when they fall short, you don't just lose the fee, you lose the fee, plus all the growth that money would have earned, compounding for the rest of your life. Fees are certain, outperformance is not. You are guaranteed to pay the higher cost and merely hoping for the higher return. Over a lifetime, that trade is a loser's bet. Reason number 2 is a piece of simple math that's almost impossible to argue with. It's sometimes called the arithmetic of active management. Here's the logic. All the investors in the market, added together, own the whole market. So as a group, they earn exactly the market's return, before costs. For every investor who beats the average, another must fall below it by the same amount. It's a zero-sum game. Now subtract fees. Active investors as a group must earn the market's return minus their higher costs. So after fees, the average active dollar mathematically has to underperform the average index dollar. Not because managers are dumb, because of arithmetic. It's not an opinion, it's addition and subtraction. Reason number 3, the market is ferociously competitive and mostly efficient. By the time you or a fund manager hears a piece of news, millions of other smart, motivated professionals have already heard it and traded on it. The price already reflects it. Finding a genuinely mispriced stock, one the entire market got wrong, is extraordinarily hard and getting harder every year. So even brilliant managers are fighting over tiny, fleeting edges against thousands of equally brilliant rivals while paying high costs to play. A few win in any given year, often by luck, but repeating it year after year is nearly impossible. The index doesn't play that exhausting game. It just owns everything, cheaply, and lets the whole market's growth do the work. If you still doubt it, consider the most famous bet in modern investing, made by Warren Buffett, one of the greatest investors who ever lived. In 2008, Buffett bet $1 million that a simple, low-cost S&P 500 index fund would beat a hand-picked selection of elite hedge funds run by the sharpest managers on Wall Street over 10 years. It wasn't close. The index fund crushed them. The hedge funds, weighed down by their enormous fees and unable to consistently pick winners, weren't just beaten. They were left in the dust. Buffett's own instruction for the money he'll leave his family: put the vast majority in a low-cost S&P 500 index fund. The greatest stock picker alive tells ordinary people, don't try to be me. So what does all of this mean for you, the everyday person with a job and no time to study stocks? It's the best news in personal finance. It means you don't need to be smart about individual stocks. You don't need to find a genius manager, decode the news, or time the market. You don't need to beat the pros. You just need to quietly ride along with the whole market by owning the index. By doing almost nothing, buying a broad, low-cost index fund and holding it, you can reasonably expect to outperform the large majority of highly paid professionals over time. Not because you're a genius, because the strategy is that good and the costs are that low. Simplicity, it turns out, is a superpower. Part of that superpower is diversification, a fancy word for a simple, powerful idea. Don't put all your eggs in one basket. When you buy an S&P 500 index fund, you instantly own a piece of 500 different companies across every major industry. If one company stumbles or even collapses entirely, it's a tiny slice of your holdings. The other hundreds carry you. Compare that to betting on a single stock. Pick right and you win big. Pick wrong and companies fail all the time and you can lose everything. The index removes that single company risk almost entirely. You're not betting on one horse. You're betting that American business as a whole keeps growing over the long run. Historically, that's been a very good bet. Let's talk about that long-run bet honestly, including the risk. Over its long history, the U.S. stock market has returned roughly 10% a year on average, before inflation. But, and this matters, that's an average across decades, not a promise for any year. In a single year, the market can soar 30% or crash 30%. There will be scary drops, sometimes brutal ones. Money you need soon does not belong in stocks. Index investing works because, over long stretches of 10, 20, 30 years, those wild swings have historically smoothed into strong growth. This is a marathon, not a sprint, and past performance never guarantees the future, which is exactly why the next idea matters so much. That next idea is compounding, the quiet engine that turns steady investing into real wealth. Consider someone who invests $200 a month into a broad index fund and simply leaves it alone. At returns near the market's long-run average, after 30 years, that steady, boring habit can grow into several $100,000, far more than the person actually put in. Why? Because the growth earns its own growth year after year, snowballing. The investor didn't pick a single stock, didn't time anything, didn't beat any pros. They just bought the whole market cheaply and let time do the heavy lifting. That's the entire strategy in one sentence. Invest regularly, keep costs low, and be patient for a very long time. Okay, the practical part. How does a normal person actually buy an index fund? It's easier than ever. You already have access through the retirement accounts we've covered, your 401k at work, or an IRA you open yourself. Inside almost any of them, you'll find index fund options. You can also open a regular brokerage account at any major firm in a few minutes on your phone. Then you look for a broad index fund. The two most common choices, an S&P 500 index fund, which holds those 500 big companies, or a total US stock market fund, which holds essentially all of them. You don't need a broker, a hot tip, or perfect timing. You need an account and a low-cost fund. When you're choosing one, there are really just a few things to check. And they're simple. First and most important, the expense ratio, the fund's yearly fee. For a broad index fund, look for something very low, ideally under 1/10%. The lowest cost options are often the best, precisely because they take the least from you. Second, make sure it's broad, an S&P 500 or total market fund, not a narrow trendy slice betting on one sector. Third, set dividends to automatically reinvest, so your earnings buy more shares and compound. That's essentially the whole checklist. Low fee, broad, dividends reinvested. Boring on purpose, and that's the point. Now let's protect you from the mistakes that trip up new investors, because the strategy only works if you don't sabotage it. The biggest killers, chasing last year's hot fund, which usually cools off right after you buy. Trying to time the market. Jumping out when you're scared and back in when you're confident, which reliably means selling low and buying high. And paying high fees for the false comfort of a professional who, remember, probably won't beat the index anyway. The worst of all is panic selling in a crash. When the market drops, it feels smart to sell and wait it out. It almost never is, because the market's best days often come right after its worst ones. Which brings us to the single most important habit. That habit is this. Time in the market beats timing the market. Almost every study lands on the same conclusion. Here's why it's so powerful. The market's biggest up days tend to cluster close to its biggest down days, in the middle of the scary stretches. If you panic sell and step out, you miss those rebound days, and missing just a handful of the best days over decades can dramatically cut your final result. So the winning move isn't clever, it's stubborn. You keep buying on a regular schedule through the good times and especially the terrifying ones, and you do not sell in a panic. You stay in your seat. Boring, consistent, and unshakable beats brilliant and jumpy nearly every time. Let's turn this into a plan. First, the do's. General principles, not personalized advice. Do favor a broad, low-cost index fund, an S&P 500 or total market fund with a rock-bottom expense ratio. Do invest regularly, on a schedule, no matter what the headlines are screaming. Do think in decades, not days, and only invest money you won't need for many years. And do let compounding work by reinvesting dividends and simply leaving it alone. Do those four things, broad and cheap, invest consistently, think long-term, and stay the course. And the data says you'll likely do better than the large majority of professionals without picking a single stock. Simplicity and patience are the whole game. Now the don'ts, the moves that quietly wreck good investors. Don't chase last year's winners or the stock everyone's hyping. The crowd usually arrives right at the top. Don't try to time the market. Almost no one does it well, and the cost of being wrong is enormous. Don't panic sell when the market crashes. That's the moment the strategy is being tested, and selling locks in the loss. And don't overpay in fees for the hope of beating an index that the data shows most pros can't beat. Finally, don't invest money you'll need soon, and don't expect a straight lineup. Stocks are a long-term, bumpy road. Respect the risk, and let time be your ally. Let's recap by the numbers. The S&P 500 is the 500 largest U.S. companies. An index fund lets you own all of them, cheaply, in one move. The evidence: in 2025, 79% of active large-cap funds lost to the S&P 500. Over 10 years, fewer than 1 in 6 beat it. Over 20 years, about 92% underperformed. The pros lose mostly because of fees, the zero-sum arithmetic of active management, and how efficient the market is. What it means for you: a broad, low-cost index fund, expense ratio ideally under 0.1%, invested regularly and held for decades, likely beats most professionals. The habit that makes it work: time in the market, not timing it. Stay the course. Here's the real takeaway. The most powerful investing tool ordinary people have isn't a secret, a stock tip, or a genius manager. It's a boring, low-cost index fund and the patience to leave it alone for decades. Wall Street's own data proves it. And even Warren Buffett agrees. At USAFinance, that's the whole mission. Hand you what you need to get, keep, and grow your money. Sourced in plain English, never advice. If this made investing feel simpler and less scary, subscribe. It's free, and it's how we keep going. And next time, we get practical about where you bank. A bank versus a credit union. Which one actually keeps more of your money in the numbers? I'm Don Blake. Make your money work. We'll see you next time.